AI continues to be a hot investment sector in the summer of 2026. We're going to discuss this, other investment topics, and much more with our latest guest, Chris Galipeau. He's head market strategist at Franklin Templeton Investments. We're going to have the pleasure of talking to him today, as well as engaging members of the audience in questions that they have about this and other topics. Chris, welcome to the program. It's good to have you here.
Hey, Patrick. Thanks for having me. Appreciate it.
Sure. I wanted to do is start out by saying, everything that we discuss, and this is primarily for the audience, everything we discuss here is for educational purposes only. This is not investment advice. This is for your education. And if there is anything that we discuss that you might be interested in investing in, make sure you contact or consult with a professional first, so that anything you put your money in is aligned with your goals and risk tolerance. With that being said, Chris, I wanted to start with talking a little bit about you personally. What inspired you to want to get involved in investing and to get you to where you are today?
Wow, good question. So, believe it or not, when I was in high school, this is back in the mid to early '80s, right? My dad was a big investor, and so he would talk about, and this is before the advent of 401k plans. At least I think that's right. It was a long time ago. Let's put it that way,
right?
Right. He would talk about simple concepts like dollar cost averaging and how to use time to compound returns over time. And so I thought that was interesting. And we would watch or read the Wall Street Journal. And in the process of my high school work, which seems like forever ago, we actually had a class. That part of the class was to play in let's call it, not really an investment club, but I grew up in Massachusetts, so it was a statewide thing for high school kids, where it was an investment competition. And so I got into it, and I remember going down to the payphone in somewhere in the school and calling my dad's broker and talking to him about stocks. And so I kind of got hooked on it then. And then I went to college and majored in it and whatnot. And so I loved it right away, which I know is maybe a little bit abnormal. And I've had it in my blood really since then, Patrick. And so that was the start of it. I went to college. I actually played golf in college, so I wasn't in class that much, and I wasn't the best college student. I get out. Got into the business, started Fidelity, I think in 1990, late 91, early 92.
Wow.
And then kind of morphed it right through there, and then realized that what I enjoyed most about all the different aspects of investing was picking stocks. So my hope was to become a portfolio manager one day, which is saying a lot when you're 21 and have no idea what you're doing. And I eventually, after 35 years, here I am. So that's how it started.
That's amazing. Yeah. Can you tell us a little bit about what led you to Franklin Templeton? Like, what is it that got you there? Was it something that you desired to do, or was it something that happened more by happenstance?
Yeah, no, it was it had nothing to do with luck really or happenstance. And so, as I said, that was my interest really was in what makes stock prices go up, what makes them go down, sort of thing. So I started as an internal wholesaler actually in 91 or 92 at FMR, and realized quickly I didn't really want to do that. But I was spending time on the floor with the different portfolio managers, legendary names that your audience will probably know, Peter Lynch, etc. Not that I knew him personally, but wow. Right.
Yeah.
And once my mind started to get expanded by just listening, like through osmosis, I thought, okay, that's what I want to do. And I ended up forming a business with two portfolio managers. We started a sell-side research firm. This is in early 94. So now I'm 23, 24 years old. And we were generating individual stock ideas and selling the research to professional money managers. Think at all the big mutual fund companies in North America, hedge funds and that sort of thing. So I did that for probably 14 or 15 years, 80
Wow.
hours a week, 7 days a week.
Oh.
That's where I learned. So that's where I learned fundamental analysis and everything that goes into picking stocks, what really works, what doesn't work, what you should keep, what you should discard, that sort of thing. A lot of trial. And then once we went through that process, we had a phenomenally successful business. And then I realized I no longer wanted to be a sell-side analyst and a sell-side strategist. I wanted to be on the other side of the phone and be managing the money. So we built up a massive client base. I took those relationships and so the owners of those firms, and long story short, got my chance to go from the sell side to the buy side, which is a very difficult thing to do. And that's how it started. I ended up running a $5 billion growth portfolio for a long time. And then I got to Putnam. And then Putnam was subsequently bought by Franklin Templeton about 3 years ago. And here I am.
Wow. I mean, that's a lot of like background and research that you did over the years to really build your knowledge.
100%.
Yeah, that's 80 hours a week. Wow. What I was going to ask was, leading into kind of where we are today, based on all this knowledge that you have and expertise that you have, where do you see the U.S. economy, and even in a broader sense, the global economy going in the next 3 years? Like where do you see it right now? And where do you see it going in the next 3 years?
So I think what we should expect is, well, first of all, long-term trend growth, real GDP growth in the U.S. is about 1.8%. Last year, the last 2 years, we've tracked above that, something north of 2, right? And I think this year we'll probably track somewhere close to 2.5, so better than long-term run rate. And the only thing that really, and I think that will continue. Now, it might not continue at 2.5. It might moderate back down, right? But I think we're going to at least match long-term run rate, if not improve on that. And so the only thing that really would throw that off course and cause that, assumption or forecast to be wrong would be the Fed raising rates, keeping rates too high, breaking something in the economy, a credit crunch or a liquidity problem, or just raising the cost of money so high that, of course, they do that to put downward pressure on aggregate demand. But if they overdo it, they can put us into recession. And that's really the only thing that causes a misstep in GDP, which consequently causes an earnings problem, which is why the stock market declines in bear markets or anything close. So not knowing what's ahead completely, I would say for the next 3 years or so in the U.S., the outlook's good. In Europe, depressed GDP relative to the U.S. That's been the case my whole career. That's probably always going to be the case. And I think about the U.S. as an innovator, right? Europe is a regulator, and then over in, let's say, China, they're a duplicator. And but I think in terms of emerging markets, you'll have even better GDP growth than you've got in the United States. But I would caution all the listeners on this one point, that the economy is not the stock market, and the stock market is not the economy. They're two completely different things. And for example, a couple of years ago, Germany was in a recession. The stock market was up 100% during that. The stock market's a discounting mechanism. It looks forward, doesn't wait, right? So you think about the economic data that we get, all of that's rear view mirror, right? I need to be looking through the windshield on point, right? And the scout team figuring out where things are going, not using economic data to try and pick stocks or gauge things. By the time you've got the data, the stock market has already reacted.
You mentioned China being a duplicator and emerging markets, having some greater growth potential. Do you believe that that'll reflect in their markets and their stock markets? I know you're saying they're different, but do you think that it might be something that, an investor could, again, this isn't investment advice for anyone individually, but just it's something that they could hedge themselves with by investing in emerging markets now before that improved GDP occurs, or not?
I think it's so the answer is yes, with additional information. That I'm not that concerned with all the talk of GDP and economic strength or weakness, absolute or relative. What really matters for stock prices, or for an index like the S&P 500, or for a country like India or Canada or Germany, is the growth in corporate earnings. So corporate profitability, corporate earnings are the number one variable for stock prices or an index or a country, period, and end of story. And people can get caught up in the headlines, the news flow, and get distracted from that. But the empirical data tells you very clearly that earnings are the most important variable. So that's what I prefer. So for example, if you look at the US here for calendar 26, we're probably going to year on year, that's somewhere between 50 and 20% by the end of the year. It's 25. These are right. Q2, we're going to start next week. It's probably going to be 15 to 22. Those are huge, huge numbers. If you go over to Europe, the numbers are much lower. If you go to emerging markets all in, the numbers are even higher. And so it's the earnings, it's the rate of change of earnings growth, forward earnings growth now, not reported, but going forward, that matters. And so today, if you look around the world and scan your radar, what you'll see is EM is in the pole position with the strongest forward compounded annual growth rate in earnings. US is second. So that's much more important for stock prices than any of the macro related data, including GDP.
You had mentioned, Chris, the only thing, or the only thing in your view, big picture, that might throw a wrench in the plans of having continued growth over the next few years would be, the Fed hiking rates more aggressively, or something being introduced into the mix that might, create a recession. What do you think the likelihood is that the Fed is tighter than the way they're communicating right now, due to any variety of reasons? It could be higher inflation. It could be geopolitical issues that keep the price of oil higher. What do you see the likelihood of that happening, vice it just kind of being, steady as she goes?
So I think for calendar year 26, it's unlikely that they move. And if you think about the conflict in the Middle East and what we've seen in oil, right? So here's the playbook for any conflict that creates a supply side shock that we just saw. We saw this with Russia and Ukraine. We've seen it in other places too. So the playbook for that is the initial spike in oil. So oil traded, now West Texas, I'm talking about, traded 122, 125. That's always a sell. So the initial pop is always a sell. The stock market does knee jerk in reaction to that, like we saw, this time pulled in 10%. Think about tariffs, pulled in 22%. But usually over time, the stock market will not be beholden to any sort of geopolitical event. And that, you get a knee jerk to it, but it smooths itself out over 3 months, 6 months, and definitely over 12 months. So for example, if you go back to 1929 and you look at every major geopolitical event, right? So we're going back to the Great Depression right through to present day. What you'll see is from the start of every conflict, right? You name it, you pick it. 1 year out, the S&P is higher on average by about 12% with a 75% hit rate. So the market ends up coming back to the variables that matter. Now, to answer your question, I don't think they do anything. I don't think there's any chance of recession in 26, probably in 27 as well. Something, even if the situation in the Middle East were to escalate substantially, right? Ask yourself this: what would raising the cost of money, raising interest rates, what would that do to the price of oil? Zero, right? It's not going to do anything. And so, as Powell said when he was still here, that our playbook here is to look through this shock and probably do nothing. I think what would, if that were to happen, a re-engagement, an escalation, and you had oil trade north of 125 bucks, you're going to have to keep it there for 6+ months to probably cause, an issue. But we have to remember too that Russia, Ukraine, it was kind of close to that in terms of, oil price elevation. My guess is they sit tight here.
Yeah, I mean, you mentioning that, I do remember looking back at geopolitical events in the past. I was thinking, I remember looking at the stock market during World War II or the Korean War, and you'll see, like spring of 1942, it drops a lot, but then it bounces right back.
Yeah.
And it's interesting when you look at it from that perspective. You're right. Usually, geopolitical events don't really drive the market as much as earnings do.
Right. But it's, when you're in the middle of it, whether it's tariffs, whether it's 9/11, whether it's something like COVID, or bubbles like GFC or the tech bubble, it's hard to separate the signal from the noise. And most of the time, the only time you get in real pain. So if you think about the analogy I use, if you go back to 1929 to present day, there were 3 periods of time where if you use the calculations that I said from the point of conflict out 12 months, this window, 12-month window, there were 3 times out of like the 70 events where 12-month returns were negative. Here they are: GFC, tech bubble, exacerbated by 9/11, and 73, 74 with the Arab oil embargo. Now, in all 3 of those cases, there was one thing that was common. The Fed was raising rates. And so I don't think, right? So we don't have that now. I don't think we're going to have that. And if I took those 3 events out of the data set, which I did not do because you need the full sample, right? Then the return numbers go up a couple percent, so probably closer to 15, and the hit rate goes north of 80. So, but it's hard in the moment, especially now, the news, social media, all these newsletter writers, all the doomsdayers that anytime the market's down 2%, they come on, hey, Patrick, national debt's going to cause the country to go bankrupt, and we need to, you need to go to cash.
Right.
Ignore all that. If you actually watch the people that they roll out over time, it's the same group, same cadre. They've been wrong for my entire career.
Right. With that in mind, Chris,
sometimes.
No, of course. Yeah, I like your perspective on this though, because you're thinking, hey, you need to think about it not just medium term, long term, but separate the noise from the real information. And that actually makes me think, what in your opinion is, with all this in mind, what in your opinion right now is a good sector to be invested in? I know everyone needs to be diversified, but is there any particular sector of the market that you see right now as being undervalued?
Well, let's start from the index level and kind of work down. So right now, with the S&P at 7,500-ish, the forward multiple is just under 22. Interestingly, on January 1, to start the year, with the S&P at about 6,850, the multiple was 22.5. So now the S&P is up 10% from that point, but the multiple has come down. Why? First quarter earnings smashed expectations, right? So the earnings estimate has cranked itself up. That's true in almost every sector, with the exception of maybe consumer staples and maybe real estate, and utilities kind of morphing here with the power gen stuff. So that's the first thing. If you get down to sectors, I think you've got to look at a combination of 2 things. You've got to look at, and there's many ways to manage money. For me as a growth guy, I would say that what we're looking for is a rate of change in revenue, EBIT margins, net income, and therefore earnings. So you're looking for positive revisions in all those line items. And you can find those stories today in many sectors, right? In many sectors. And so the stock market, as we're sitting here, is very broad, meaning there's broad participation. There's not really one basket of stocks or one industry or one sector that's in full command. Of course, technology is what gets all the airplay. AI is a big thing, right? And for a lot of reasons. So I think technology continues to look really good. Financial, same thing. If you ask me to pinpoint a sector that looks cheap on a multiple basis, where the earnings growth looks okay, you could probably go toward healthcare. But the industrial names look really good. Some of the material names look really good. This is about as broad a target list as we've had in at least probably 10 years. Yeah.
Why do you think, you'd mentioned it's a broad growth?
Yeah.
Why do you think AI and tech are getting so much media attention if their earnings aren't, that much more spectacular than some of these other sectors?
Well, I think you're talking about unbelievable disruption at a pace that we've probably never seen. If we compare this back to the tech bubble in 2000, so you guys will laugh at this, but I was 31, 32, managing money, thought I had all the answers. I was just confusing my intelligence for a bull market, right? But the rate of change in growth and the step function change in our lives by the internet, right, and then mobile phones and all that sort of stuff was incredible to watch. This is the same thing, probably times 2, where the implications here, I think, are bigger than most people think, right? Now, so the earnings picture looks very good here. I think it gets all the airtime because of the disruptive nature, and once in a while we'll hear, oh, AI is going to, take jobs or put people out of work, or AI is going to massively improve productivity, efficiency, profitability. I think it's the latter, not the former. But it does get a lot of airtime. You've got trillion-dollar market cap companies. You get SpaceX to come, the biggest IPO in history. And so that's why it gets the airtime. But if you step away from that and you look at Eli Lilly, right, which is not as sexy a name, you have unbelievable earnings growth there too. And JP Morgan, and there's plenty of names that have it, but tech definitely gets the headlines. And I just think there's a lot to talk about there is probably the reason.
Is in your view, there's been some discussion about, inflation heating up over the next few years. And, not necessarily that it would return to double digit rates, but that it would at least be higher than it was in the 2010s, right? We're probably not going to be in the era of 1% and 2% inflation anymore.
Yeah.
But if it is higher in the future, and if you see it that way, do you think that value stocks or value indexes could have greater potential as far as returns vice the growth, or is it not the case in your view?
Yeah. First of all, equities in general are a great hedge against inflation, right? To be specific, the best performance in periods of high inflation or rising inflation, small cap value is the outperformer. I think on a go forward basis, I wouldn't expect, we're probably at peak inflation right now. How about that for a quote? Probably right here, right now. We're actually probably past it, right? And the reason I say that is if you look at market-based instruments for an approximation of forward inflation, 1 year break-even rates, 2 year break-even rates, 5 year break-even rates, 10 year break, you pick your tenor. If we just take 1 year break-even rates, which is the difference between nominal rates and tips, which is the bond market telling you, hey, here's what we expect inflation to run at for the next 12 months. It just went from 550 in March, start of the conflict, to 140 now.
Wow.
Same in 2 year, same in 5 year, different levels, but same order of magnitude down. So that's telling us, hey, we're probably past this. The AI thing is interesting because if you look at what Apple said a couple of weeks ago, we need to raise the price of our phones and iPads and Macs because our cost of goods sold, our input costs are rising. Most of that's memory, DRAM. So that is Apple passing on the cost to you and I. That's inflationary, right? But for the beneficiaries of that, Micron, SanDisk, Hynix, Samsung, Qualcomm, Broadcom, etc., that's bullish for them. So in the near term, maybe there's a little bit of inflation push there, but broader, longer term, I guess, I think what people would agree with, and I do, is that technology is a disinflationary force, meaning it should put downward pressure on costs going forward. And so we're seeing that with AI in a lot of cases. Q2 earnings start next week. Listen to these companies, pick 10 in different sectors, different industries. Listen to the management teams talk. I guarantee you that you'll hear on every single earnings call how the company is using AI to improve efficiency, productivity, and hopefully, ultimately, profitability, right? We've heard that for probably the last year. Now the number of companies that are talking about it and providing tangible, analysis of it, ROI for it, is growing every quarter. So I don't think we have a big inflation problem on a go forward basis. Let's hope I'm right. It's funny that you bring up the tens. Remember that in that time period, we were screaming for just give us a little bit of inflation, right? Because it was sub 2, and deflation is much worse than inflation. Now we've got it. People are like, oh, it's untethered.
Right.
Can't win.
Right. It is, in your view, is the tech, not only is it disinflationary, but is there particular parts of tech that you see as having that pricing power? You've mentioned Apple. Again, we're not recommending anybody buy Apple. This is just, for educational purposes, but using that as an example, are there parts of tech that have that pricing power where if we do have a burst of inflation in the future, they're able to kind of keep up, if you will?
Well, yeah, I mean, it's kind of hard to distill all that because it's going to morph and change depending on what's actually happening under the surface. So we'll go back to the example we just used. So Apple's input costs for memory chips, maybe other things are rising. They're passing the costs on. As soon as their cost of goods sold, the materials bill starts to come down, they'll probably reverse that. So for right now, present day, Micron, SanDisk, etc., are winning because they've got the pricing power, and Apple's still the only company in the world, right, with a multi-billion-dollar embedded base of clients that when they released a new version of this, we drop this old guy and we're happy to go pay up for the new version every single time, right? So
Right.
it's really hard to say, but ultimately, management teams are paid a lot of money to navigate, dynamic situations, right? Improvise, adapt, and overcome. That's probably familiar to you, right?
Yes.
That's what they're paid to do, and they do it very, very well, right? So there are a lot of levers that management teams can pull on their income statement to deal with a whole host of situations, whether it's, let's take rising costs and tariffs last year, which impacted potentially a lot of companies. What do we do? So what do Chris and Patrick do if we're at the helm and our cost of goods sold is up 10%? We have a couple choices. We can eat it, right, and try and offset that somewhere else with cost reductions within the company. We
Right.
can pass some of it on. We can pass all of it on. We can ask our suppliers to take some, or we can do a combination of all of that, right? Most management teams coming out of the tariff thing last year ate the cost or had their suppliers absorb it, and maybe some passed on some costs to us as consumers. But for the most part, companies absorbed it, and the stock market looked through it as a one-time sort of thing, right? So it's always different, but I think I fall back on that management teams are paid to adapt and manage under stress and duress, and they do. U.S. companies are the best in the world at that.
You bring up a good point, because I think a lot of times the general populace is under the impression that corporations are just increasing prices, all the time. Whereas in reality, they don't want to. Usually when they do, it's like they have to. It's, they're being squeezed. And a lot of times they're just absorbing these costs because they don't want to lose their customers.
100%. So if you look at Walmart as an example of that, now there's a Walmart within 10 miles of every U.S. citizen, right? It's the biggest grocery store in the world and one of the biggest employers in the U.S. So Walmart, I forget what the breakdown is, but let's just say for argument, they import 50% of the goods that they sell in the stores overseas, most of that from Southeast Asia. I don't think the number is that high. It might be a little lower. But anyway, here's what they told us. This is going back last year. Hey, our cost of goods sold are rising. We're going to be able to mitigate a lot of that, but we're going to have to pass some of it on in some of the SKUs. Not all of it, but some of it. And to your point, the companies will have to do that. But ultimately, they want to keep prices low because they want to retain their customer base. They don't want to go to a competitor. So look what Walmart did last week. Or no, maybe it was this week. They came out and said, you know what? We're going to mark the price of our ground beef down by 15% in stores. So they want, and they emphasize this over and over and over, they want to keep prices affordable as best they can. And they do a very good job of it.
Speaking of, getting into those businesses that are doing a good job of managing the bottom line. And I know we talked a little bit about maybe areas that you could invest in. A lot of our viewers are military veterans, and some of them are active duty, and we save in the thrift savings plan, which is kind of very limited method of saving for retirement. Not a bad one, but it's very general. Is there an alternate way, in your view, that could be a safe and cost-effective way to invest money in other indexes? Like, again, this isn't not financial advice, but for instance, if we said, hey, they're going to invest in healthcare, are there examples of like low-cost index funds in healthcare, that you think would be a good alternative to just putting your money in an S&P 500 fund?
Yeah. Well, first of all, thank you to everybody who's on the call here who's either active duty on an FOB or has served the country. Thank you. I think the powerful thing, Patrick, is it almost doesn't matter. So I've done a lot of work on this. It almost doesn't matter what you invest in, but what really matters is you invest as much as you can for as long as you can. And so I think you mentioned the S&P 500 index. That's a great place to start. And so the concept of, I don't exactly know what the thrift plan looks like that you referenced and what the options. But if you're using that, you want to just save as much money as you can and invest it continuously every month, every quarter, every year. don't get waylaid by, what's happening on the news or what the stock market is doing, because ultimately, what you want, and especially true, the younger you are, you want stock prices to go down, and you want them to stay down for a long time. That way your cost basis is low. People forget that when stock prices are coming down, you know what else is coming down? The risk in owning them, right? So don't lose sight of that. So, but whether it's the S&P 500, whether it's, you want to pick some sectors, it's all good. Just be cognizant of what the S&P 500 weightings are. So it's a growth index now, heavy in technology, right? But I think that concept of investing over time and for time and all the time is much more important than you want to get into the nitty gritty of the asset allocation and, US versus overseas and that sort of thing. It's let your money work for you. While you're defending the homeland, let your money work for you.
Well, thanks for saying that for our veterans, Chris.
Yeah.
I know something you mentioned reminded me of when I was in the service. I remember even telling, some of the Marines that worked for me, I would say, hey, when you get a pay raise, just have it automatically go as an automatic allotment into your thrift savings plan, so you don't even see it, right? So it's right. Almost like you don't even know it's there.
But 100%, it's good advice. And make sure you use the auto escalation function. That if you're now out working for a company that has a 401k plan, now many plans will allow you to select a function that every year walks up your contribution amount, say from 5% to 6%. And I understand there are limitations and whatnot, but the more you can save, the better off you're going to be.
I do have a couple questions from the audience. Okay. One of them is, it says, how do I know when I should sell an investment? Kind of a broad question.
Yeah. Good one, though.
It is a good one.
Yeah.
Any thoughts on that, Chris?
Yeah, sure. Generally. So a couple things. So as a mutual fund manager myself for a long time, the easiest thing to do really is to buy a stock. The hardest thing to do is know when to sell it. What do you look for? What are the metrics? How do you know, right? Now, you're always acting with imperfect information, so you don't really know. I would say that the biggest driver of that is make sure that you know your time horizon. What are you trying to accomplish? Are you investing for a month, right? And it's kind of like rolling the dice. Are you investing for a year, 5 years, 10 years, 38 years? What's your number? The longer the horizon is, the less I would worry about trying to make tactical decisions, because here's what we know, guys. Over time, the stock market goes up. Annual return, 8 or 9%, right? You have years that are much better. You're going to have years that are worse. But over time, the compounding thing is real. Google the rule of 72. So your money will basically double every 7 years with 8%, 9% return. That's really powerful. There's so many different tools you can use to know when to sell, Patrick, that it's kind of tough to narrow it down. But I would start with the time frame. Make sure you understand why you're doing what you're doing. You have to understand that first, and then the applicable time horizon, right? If you're training for a marathon, an Ironman, or you're training to go into combat, it takes a long time to get in shape, and you've got to put a lot of work into maintain your condition, right? Discipline, food, sleep, recovery, hydration, all that. It's not that dissimilar for investing. The longer the run, the longer the ruck, the more discipline you're going to need and preparation you're going to need.
Right. Yeah. I think you bring up a good point about, being kind of what's the end state desired, right? And that being a bigger dictation of when you sell vice, just knowing what number to sell at. Or
yeah, if you start there with the timer and then work your way backwards, it's probably a little bit easier.
Yeah. Yeah. Well, Chris, how do viewers, if they want to get in touch with you, they want to follow you or, read your work, how would they reach out to you? Or, if they wanted to do business with you, how would they find you?
All right. So they can't do business with me. But if you want to read my thoughts, you can definitely do that. So the easiest thing to do is hop on your phone or your computer, go to LinkedIn, find my name. It's on the screen. And then if you scroll down a little bit, you're going to see that you can subscribe to a weekly market letter. It's called From the Market Desk. And in there, I write about everything Patrick and I talked about, really, but economic information, stock market, the bond market, and that sort of thing, and try and keep you informed. That's really easy. If you subscribe to it, it's free. It'll be pushed to your inbox Monday morning, 0700.
Excellent.
Yeah.
Thank you. Yeah.
You bet.
Well, Chris, I mean, it's been a real pleasure having you. Thank you so much for sharing your knowledge and experience, so many decades of experience that you have in this, especially with our service members. We really appreciate it. Love to have you back at some point in the future if you'd be interested. And we really appreciate you being here with us. Yeah,
listen, I appreciate being here. I appreciate all you guys, you too, Patrick, for everything that you do. Here's, as I said to Patrick over email, land of the free, home of the brave. Bet your ass. Thank you. And to the viewers, thanks for watching. Please remember to like and subscribe.